Okay, so we're going to start in the next chapter. The chapter head is marginal costing. Another popular name for this chapter is something called the CVP analysis. That is cost, volume, profit analysis. Now, as the volume changes, now as the sales quantity changes, now what is the impact on total cost of manufacturing and selling the product, and what is the impact on profit? Now remember one thing, so the cost incurred in manufacturing and selling a product, can be classified into two broad heads based on their behavior. Now based on the cost behavior, you got to classify the cost into variable cost and fixed cost. Now you all have done this concept of variable cost and fixed cost in the chapter even budgets and budgetary control. We know that the variable cost is driven by the quantity produced and sold, whereas a fixed cost, or if you like you can say fixed cost, remains constant. It doesn't matter how many units are produced and sold, the cost will be the same, at least for a given range. Okay, it doesn't change. And now just see the given the income statement, and this is how you make something called a contribution income statement, or we call this as something called the marginal cost statement, or it is a profit statement using the marginal costing technique or using the marginal costing principles. Now refer to the format given. I given data for 2 years. So year 1 and year 2, I've given two statements. And I call these statements to be contribution income statement. I given for 2 years, year 1 and year 2. Now refer to the year 1 income statement. Yes, Renuka, read that.
So year 1 contribution income statement, particulars and amount column. Sales or revenue, 10,000 units at rupees at 200 each, 2 lakh rupees. Less variable cost, 1,000 units at rupees 120 each, 1 lakh and 20,000 rupees. So contribution margin is 80,000 rupees. Less fixed cost, 20,000. So operating income or profit is 60,000.
Now listen.
It's 1,000.
So it is sales of 1,000 units are sold in year 1, assumed. At rupees 200 is supposed to be the selling price per unit. And you should know by now that sales are nothing but, you can say, P into Q. That is price or the selling price per unit, that into the quantity. Q stands for the quantity sold. Okay, produced and sold. And we assume that in all these sums, there is no opening or closing stock, quantity produced and sold. Okay. So 1,000 units are produced and sold at rupees 200 per unit. What is the amount? 2 lakh rupees is your revenue from operations or sales. And variable cost, that means the variable cost of producing each unit. This will include your cost of direct material, direct labor, and other variable overheads. All put together, rupees 120 per unit. And that into 1,000 units are produced and sold. That will translate to 1,20,000 rupees. Now, please remember your sales minus variable cost is known as a contribution margin, or simply say contribution, doesn't matter. So, how much is that? Rupees 80. That is 2 lakh minus 1,20,000. 80,000 is your contribution, or you can call that as contribution margin. And minus, it's going to be, it is a fixed cost. All your fixed expenses. It doesn't matter fixed factory, office, or selling. So fixed cost assumed how much? 60,000 rupees. And what is the profit?
No, 20,000.
Or 20,000 fixed cost, okay? And what is your operating income?
Our profit is 60.
It is 60,000 is your profit. I'm sorry, 20,000 fixed cost and the profit is 60,000. You call that as profit or operating income. Okay, 60,000 for year one when you sold 1,000 units. I remember the contribution amount is nothing but 200 selling price, 120 variable cost. Okay, into 1,000 units. So 2 lakh minus 1 lakh and 20,000, 80,000. Less your fixed cost 20,000, profit 60,000. Now year two.
Yes, sir. Year two contribution income statement, particulars and amount column again. Sales or revenues, 1,600 units at rupees 200 per unit, 3 lakh and 20,000.
Now I assume that 1,600 units are sold in year two. I will take the statement from here, okay? 1,600 units are sold at rupees 200 each. And amount is 3 lakh and 20,000. And less variable cost 1,600 units into rupees 120 per unit. And that works out to rupees 1 lakh and 92,000. The contribution margin is 1 lakh and 28,000. Unless your fixed cost, that doesn't change with the volume, same 20,000 rupees. So what is your operating income or profit? So works out to 1 lakh and 8,000, right?
Yes, sir. 1 lakh.
1 lakh and 8,000 is your profit or operating income. Now I made these two statements for me to make you understand all the possible relationships. That is all the equations I want to derive from these two examples. Okay. Now, if you remember these two examples really well, and with the help of these examples, I'll teach you how to calculate the break-even point, and how do you calculate the target sales, and what are the different equations for finding out the contribution. There's something called the contribution to sales ratio, also known as a PV ratio. And that is the reason I given two income statements. Okay. Now, once I complete the entire discussion, you can go. One thing you do, I'll pause the recording now. Now, why don't you write down these two statements in your notebook? Just jot down. Okay. I can pause the recording now. Okay, so guys, we're going to now start with a set of equations. Now, what is our first set of equations, ma?
The contribution margin.
Basically, how to understand or how to calculate the contribution margin, right? Now, I've given all the possible equations to find the contribution margin. Yes, under that, what is the first one?
So contribution margin per unit is price minus the unit variable cost.
That is all. It's a selling price. When I say price, I am referring to the unit selling price. Now we know that the price is in this example how much? Rupees 200 per unit. Minus what is the variable cost? It is 120 per unit. And rupees 80 is called a contribution margin per unit. You can either say contribution per unit or contribution margin per unit is rupees 80 per unit.
Network issues.
Shall I start?
Yeah.
Okay, remember that the formula is a contribution margin per unit is selling price minus unit variable cost. In this example, rupees 200 minus rupees 120, rupees 80 is your contribution margin per unit. Next.
Number two, contribution margin is sales minus variable cost.
That is in case you want to find the amount, the total contribution margin will be sales minus variable cost. Please refer to the statements you made. You made two statements, right? Year one, year two. Example, 2 lakh rupees minus 1 lakh and 20,000 rupees, or 3 lakh and 20,000 rupees minus 1,92,000, right?
Yes.
So sales minus variable cost will give you contribution margin or just contribution, not per unit, in total. Then number 3.
Number 3, contribution margin is equal to fixed cost plus operating income.
Just see the year 1 or year 2. Now just see what is the amount of fixed cost. It is 20,000. And what is the profit? 60,000.
Oh, yeah.
Now what is 20,000 plus 60,000? 80,000 contribution.
Yes.
Or you take year 2. It is profit in fixed cost 20,000 and profit 1,08,000. Add both, you'll get 1,20,000. Working backwards. So remember, if you add your fixed cost and profit for the year, you will get the contribution amount. When I say contribution amount, I'm referring to a contribution margin, not per unit, contribution, right?
Yes.
Is rupees 1,28,000 for year 2. If you add up 20,000 and 1,08,000. Next.
Contribution margin is equal to fixed cost minus operating loss.
If there is a loss, then you subtract. Profit, you add up, right?
Yes.
That's it.
Yes.
These are the possible equations under contribution. People should understand why this number is called contribution. Let me explain that. Now refer to year 1 income statement, guys. Now you know that each unit is sold at rupees 200 each. And each unit is produced at rupees 120 variable cost, unit variable cost. So 120 rupees worth of product is sold for 200 means what? I earn rupees 80. That means what? Each unit sold contributes rupees 80 towards recovery of fixed cost. That is what it's called contribution. That means each unit sold by the company contributes rupees 80. So the 1,000 units sold is contributing rupees 80,000. But after absorbing a fixed cost of 20,000 rupees, you still have a 60,000 rupees extra contribution, which is nothing but your operating profit. That is a contribution amount in excess of fixed cost is your profit. Think about that. We call this as contribution because each unit contributes rupees 80. What is 80 into 1,600 units? Will give you for year 2, that is. 1,600 units and the 80 will give you how much? 1,28,000. Out of 1,28,000 amount contributed by these units, minus 20,000 fixed cost absorbed, and you still have a 1,08,000 surplus, and that is your profit. Understood?
Yes.
Yes. And that is your contribution. Okay. That is the first set of equations. I will discuss one more set of equations, then you can take down. Number 2.
So B, contribution margin ratio or percentage.
Very popular, contribution margin ratio, or you can say contribution margin percentage, also known as PV ratio. Okay, profit volume ratio. Yes, ma'am.
So number 1, contribution margin per unit divided by price per unit into 100.
In our example, what is a contribution per unit? By now we should know
rupees.
rupees 80 per unit. Now what is 80 rupees upon 200 selling price into 100 is equal to 40%. So that is your contribution margin ratio. Nothing but divide the contribution per unit by the selling price per unit into 100. So 40%. What is the meaning? For every 1 rupee you sell, 60 paise goes off in variable cost. If you notice what is 120 rupees upon 200, it is 60% variable cost. 60 paise gone, what is the balance? 40 paise. 0.4 or 40% is your contribution to sales ratio. Understood? Then what is the second equation, ma?
Yes, sir. Contribution margin divided by sales into 100.
What is instead of per unit? What do? You take in total. Example, you take the first year. First year, what is the contribution margin amount? It is 80,000 rupees. What is 80,000 rupees upon 2 lakh rupees sales into 100? Again, 40%. Whether you do contribution margin per unit by the selling price per unit into 100, or you take the contribution margin amount, which is 80,000 rupees, upon 2 lakh rupees sales into 100, it is 40%. Next.
The next is 100 minus variable cost percentage.
Which I discussed.
Yeah.
I can find the variable cost as a percentage of sales. For example, I can divide 120 rupees upon 200, which is 60%. Or I can take the variable cost amount. How much? 1,20,000 for year one, for example. I can take 1,20,000 rupees upon 2 lakh rupees. No, sir, I want to do with year two. No problem. Divide 1,92,000 by 3,20,000. How much you get? 60%. So variable cost is 60% of sales. I can say that my contribution is 40% of sales. It is no brainer. Because a variable cost is 60% of sales. Example, if 120 rupees upon 200 is what? 60%. Then the balance rupees 80 contribution by 200 should be what? 40%. That is why 100 minus variable cost a percentage will give you the contribution margin percentage, also known as PV ratio. Remember, the entire set of equations given, contribution margin ratio or contribution margin percentage, also known as what? The PV ratio. It's all the same. And there's one more equation given for finding out the contribution margin percentage. Yes, ma'am.
So change in profit or operating income divided by change in sales into 100.
You saw that is why it gets the name PV ratio. Change in profit divided by change in sales into 100. For example, you take year one. Now tell me year one, what is the profit, guys? 60,000, right? And year two, what is the profit? 1,08,000. So what is the change in profit? It is 48,000 rupees. Is the change in profit is 48,000. And divide that by the change in sales. What is the change in sales?
1,20,000.
2 lakh rupees goes up to 3,20,000 year two. So 1,20,000 rupees. Now what is 48,000 upon 1,20,000 into 100?
40.
It is 40% is your contribution margin ratio or percentage. So remember, change in profit by change in sales into 100. People wonder how come that is working. I'll tell you why. Everybody refer to year one contribution amount. It is 80,000 rupees. What is the year two contribution amount? 1,28,000. What is the change? Same 48,000. So how's the change in profit and change in contribution? Both are 48,000. Why?
Fixed cost.
Exactly. The fixed cost remains fixed. It's as simple as that. Therefore, the change in profit is driven by change in contribution. And that change in contribution is driven by what? Change in quantity sold. Yes or no? In other words, a change in profit is driven by the change in contribution amount, and the change in contribution amount is driven by change in sales. That is nothing but the sales quantity into selling price. Is that fine?
Yes.
That is why the PV ratio is another name for what? Contribution margin percentage or ratio. It's called the profit volume ratio. Change in profit by change in sales into 100. Remember, when I say change in sales, denominator, not the quantity. Change in sales, value, which is in our example, 48,000 change in profit, year one, year two, divided by change in sales amount is 1,20,000 rupees. How? 2 lakh rupees and 3,20,000. right?
Yes.
So I want people to go ahead and take down the first two sets of equations. That is what? Contribution margin and contribution margin ratio percentage, also known as what? PV ratio. Have you written that heading of PV ratio?
No, sir.
No, please write PV ratio. For the second set of equations, do write a PV ratio, P/V ratio. Is that fine?
Yes.
So pause the recording, go ahead and take down.
Yes, sir. All right.
So that is, we are done with A, contribution margin. We are done with B, the contribution margin percentage ratio, also known as PV ratio. And now we want to start with point C. What is that?
Break even.
It is a break-even point. Now, people should know break-even point, nothing but the no profits, no loss situation. It is as good as a hand to mouth. Okay, no profit, no loss. That means zero profit. Okay. Now, everybody, please refer to the year one or year two, whatever. Refer to year one contribution income statement. Can we have that on the screen now?
Yeah.
On the screen, we have the year one statement. Let us say I want to find what is break even. Break even point is where I earn no profit and I do not incur any loss. Okay. Now think of this income statement. What is sales we are shown? 1,000 units into 200 each, right? Let's assume we don't know the break even point units. X into 200, right?
Yes, sir.
Just follow my voice. It is X into 200. And then less variable cost, again what? X quantity into 120. So what will be a contribution? It will be X into 80 per unit. See, 1,000 into 80, only 80,000. By now you should know that the contribution amount, nothing but the quantity sold into contribution per unit. So 1,000 into 80 is 80,000. But here we don't know the units. X, the break-even point.
And that
into rupees 80. So 80x is your contribution. Minus fixed cost, how much?
20,000.
20,000. What is the profit? Should be zero. I want a zero. And now I can say x into 80, 80x minus 20,000 equals 0. So what is x? I can say in other words 0.8x or 80x equals what? 20,000. Because 80x minus 20,000 equals 0. Okay. Or 80x equals 20,000. In other words, what? Remember, break-even point. Break-even point is a point at which your total contribution from the quantity sold will be equal to a fixed cost. So I can say 80x is equal to 20,000. So what is x? 20,000 by 80. That means what?
250.
You have to sell at least 250 units to break even. If you sell 250 units, what? You will earn a contribution equal to your fixed cost. And you can cross-check also, if you don't trust me. What is 250 units into rupees 200 selling price? 50,000 sales. And less your variable cost. 250 units into 120 will be 30,000 rupees variable cost. What is your contribution?
20,000.
Will be 20,000 rupees. Minus fixed cost, 20,000. Zero profit. Now, please remember the break-even point. You can either calculate the break-even quantity, that is a break-even number of units in quantity. You can also calculate the break-even point in what? In sales value. Now, in our example, we got now 250 units break-even number, right?
Yeah.
How to find the break-even sales? Very simple. There are two ways. If you have the break-even point in units computed 250 units, you had to sell each unit at what rate? At rupees 200 per unit. And that is a rate or selling price per unit. You'll get 50,000 rupees. Of course, there's another formula to find the break-even sales directly. But once you have the break-even number of units, or we say the break-even quantity, you finding the sales, break-even sales, no big deal. Okay. Now let's go through point C. Under that, 1, 2, 3 equations. Yes, ma. 1.
So number one, break-even quantity or break-even number of units is equal to fixed cost divided by contribution margin per unit.
So in our example, what is the amount of fixed cost? Is
20,000
20,000 rupees. Divided by, we know contribution per unit is rupees 80, which is selling price minus unit variable cost. 200 minus 120, 80. Now what is 20,000 rupees upon 80?
250.
You got to sell 250 units to break even. That is your break even number of units. Next.
Next, break-even revenue is equal to break-even quantity into unit selling price.
Whenever you have the break even quantity already calculated, multiply the break even number of units into the selling price. You got to sell 250 units at rupees 200 per unit. Now, how much you earn or you'll get? 50,000 rupees. That is a break-even sales. You have to sell at least 50,000 rupees worth of goods. You know, there's another formula to find the break-even sales. What you can do? You can take a fixed cost numerator divided by what?
Contribution margin percentage.
Or PV ratio. You can divide by PVR. This PVR is PV ratio, profit volume ratio, and not the same as. Okay. So divide your fixed cost by PV ratio. In our example, what is the fixed cost? 20,000 rupees. And what is your contribution percentage we got? Remember 40%?
Yeah.
We discussed the whole of point B set of equations.
Yes, sir.
Now what is 20,000 by 0.4?
50,000.
It will be, I'll tell you why. You know that for you learn a 40 paise contribution for every 1 rupee you sell. But how much you want to earn as contribution to break even? At least equal to what? Your fixed cost. Remember, break even point is what? Where the contribution earned should be equal to what? Your fixed cost. So to earn 20,000 rupees contribution, I have to sell how much worth of units? So 20,000 divided by 0.4. Why? If I want 40 paise contribution, I better sell what? 1 rupee worth of product. If I want 20,000 rupees contribution, which is equal to my fixed cost, I should sell how much? It will be 20,000 divided by 0.4. Is that fine?
Yes.
So fixed cost by contribution margin percentage. If you want, you can also write it down that way. If I want 0.4, what is 0.4? Remember 40% PV ratio? 0.4, 40 paise. If you want 40 paise contribution, you better sell 1 rupee worth of product. If you want a 20,000 rupees contribution, which is equal to fixed cost, then you have to sell how much? 20,000 divided by 0.4. You have to sell 50,000 rupees worth of goods. Understood?
Yes, sir.
And these are the 3 equations. One is the break-even number of units. Number 2, finding out the break-even sales using the break-even number of units. And there's one more formula. Directly you can find the break-even sales. Fixed cost by contribution margin percentage. Is that fine?
Yes.
Now please go ahead and take down these equations. Point C. You can pause the recording now. Okay, so now we are done with, remember point A, contribution margin. And point B, contribution margin ratio or percentage or PV ratio. And then point C, the break-even point. And point D, something called?
Target sales.
Now people refer to year 2 data. Go to year 2. Everybody refer to year 2. Can we have it on the screen?
Yes.
Now tell me in year 2, what is the profit? 1,08,000. What is your fixed cost? One above that, 20,000. So adding both, what do you get? You get 1,28,000 contribution amount. Is that clear? And if I divide that by contribution per unit of rupees 80, what is 80? 200 selling price and 120 variable cost per unit. 80. Now tell me what is 1,28,000 by 80?
1,000.
Exactly. That means what? If somebody is going to ask a question, how many units I have to sell to earn 1,08,000 profit? What are you going to do? You have to earn 1,08,000 profit after charging 20,000 fixed cost. That means what? you should earn 1,28,000 contribution. Yes or no?
Yes, sir.
Adding your fixed cost and profit. You know, if you recall, we had done a similar sum, finding out the target contribution. We did this in budgeting one chapter. I think Rishabh had a doubt in that some sub-assembly, 1, 2, 3, whatever, all fancy names are given, right? So please remember, when you add your fixed cost and profit, you'll get something called the target contribution you want to earn. Let us say your target operating income is 1,08,000 here, 108,000. Suppose you want to earn 1,08,000 profit. After meeting or after incurring a fixed cost of 20,000, you should earn 1,28,000 contribution. You all agree with that?
Yes.
That is, adding your fixed cost and profit gives you what? The contribution required. And if you divide that by contribution per unit, you will get the number of units you have to sell. And that is called the target quantity. You get it?
Yes.
Always remember, whenever you start a business, initially what? You want to at least break even. And once you break even, what? Then you become greedy. You want to have a target profit in mind and then work towards it. Okay? Now, please remember, when you add your fixed cost and your target profit gives you what? The target contribution. Divide that by 80. And you'll get number of units you have to sell to earn that profit. 1,600 units. Now, can you find the target sales value? Very simple. 1,600 units you have to sell into rupees 200. You have to sell rupees 3,20,000 worth of goods. Right?
Yes, sir.
Rupees 3,20,000 worth of goods. There is another way to find the 3,20,000 rupees directly. What you can do, you can add your fixed cost and profit. That is 1,28,000 numerator divided by what? The PV ratio or contribution margin percentage divided by 0.4 will also give you 3,20,000 amount directly. Just see, under point D, equations 1, 2 and 3. What is 1?
Target quantity is equal to fixed cost plus target operating income divided by contribution margin per unit.
So now you understand, even if you forget this formula, you remember this year 1, year 2 statement, you can work backwards. Because you know the profit is 1,08,000 for year 2, and then add 20,000 fixed cost, that'll give you 1,28,000. And if you divide that by rupees 80 contribution per unit, you have to sell 1,600 units to earn that profit. Very simple. Then number 2.
Target revenue is equal to target quantity into selling price per unit.
So 1,600 units, once you get the target quantity to be sold, if you want the target revenue in rupee terms, you have to sell 1,600 units at rupees 200 each, 3,20,000. Or what is point 3?
Target revenue is equal to fixed cost plus target operating income divided by contribution margin percentage.
You can use that formula, but straight away you'll get the target revenue. Otherwise what? You have to find the target quantity and then find the target revenue. Or if you want to find the target revenue, directly you can use the formula fixed cost plus the target profit divided by the whole divided by the PV ratio or contribution margin percentage. Is that fine?
Yes, sir.
So please go ahead and take down these equations. Now listen to me, guys. Before I start with point E, something called the margin of safety. Okay, let me tell you what it is. For example, you take a year 2. Can I have the year 2 on the screen, Mark? Year 2 statement.
Yes, sir.
Now, what is a profit made by the company?
1,08,000
1,08,000 profit made by the company. People ask me, sir, why not year 1? I can take year 1 also, no problem. But I've taken year 2. So let us say 1,08,000 is a profit made by the company in year 2. By selling how many units?
1,600 units.
The truth is, the 1,08,000 profit is made by selling 1,350 units, more than the break-even point. I can prove that. Out of 1,600 units sold by the company, we know in this example, what is the break-even quantity? Remember, we got 250 units. Recall. We got 250 units.
Yes, sir.
Break-even quantity, 250 units. But the company sold 1,600 units in year 2. That means what? The company sold 1,350 units more than the break-even point. You know, that is supposed to be the margin of safety. You know that? The actual sales quantity is 1,600 units. And the break-even point, okay, that is supposed to be like a 40 marks in examination, right? The difference is 1,350 units is your margin of safety. In fact, 1,08,000 is a profit made by selling 1,350 units more than the break-even point. Everybody take a calculator and do this for me. 1,350 units into rupees 80 contribution per unit. How much you get?
1,08,000.
That is a profit 1,08,000. You know that? So basically the profit is nothing but the quantity sold above the break-even point. That into contribution per unit. That means what? There is a link between your profit reported and what? The margin of safety. Yes or no?
Yes.
And one more thing, the margin of safety can also be expressed in rupee terms. That's what you normally do. So tell me, what is 1,350 units extra sold more than the break even? That's what I meant extra. What is 1,350 units into rupees 200 per unit? Works out to 2,70,000 rupees is my margin of safety amount. There is another way to get 3 lakh and 2,70,000. How? We know the sales in year 2 is 3,20,000 rupees. And what is the break-even sales we got?
50,000.
Remember 50,000 rupees we got from our discussion.
Yes.
So what is 3,20,000 minus 50,000?
2,70,000.
Exactly. And one more thing, what is 2,70,000 rupees into 40% PV ratio? Will work out the 1,08,000 profit. You saw that? Basically what here? Multiplying 2,70,000 by 40% is as good as 1,350 units into 80 per unit. Contribution per unit. But the point is there is a link between your margin of safety and what? The profit you make in that year. Understood?
Yes.
Now there are two equations. And one more thing. Remember, margin of safety is expressed as a percentage of sales. I'll tell you that also. Okay.
Yeah.
Now let's see the equations. Point E. What is given?
Sales minus break-even sales.
So people have a doubt. So when I take sales quantity minus break-even quantity, yes, you can do that. But generally, we express the margin of safety in what? In rupee terms. Example, I'll take sales 3,20,000 rupees in year 2. Minus the break-even sales will not change. How much? 50,000 rupees. Doesn't matter year 1, year 2. For the company, the break-even point is 50,000 rupees in rupee terms.
Yes.
What is 3,20,000 minus 50,000?
2,70,000.
So for year 1, what is the margin of safety? I'll take 2 lakh rupees sales minus 50,000 break-even sales. 1,50,000. Right?
Yes.
So that is one formula for margin of safety. Or another formula.
Another formula is profit or operating income divided by contribution margin percentage.
You can check now. Take a calculator. What is 1,08,000 divided by 0.4 or 40%?
Yeah.
You get 2,70,000 rupees as your margin of safety. Okay. And any other equation? No.
No, sir, but percentage.
But there is a note.
Mm.
Margin of safety is expressed as a percentage of sales.
Yes.
For example, we got 2,70,000 margin of safety for year 2. Divide that by 3,20,000 rupees sales into 100. Now, what is 2,70,000 upon 3,20,000 into 100?
84.3.
That is your margin of safety percentage. Please know this. Margin of safety, whenever they're given the percentage in the question, it means they have expressed the margin of safety as a percentage of sales. Is that clear?
Yes.
And with that, you complete all the equations that you have to know for the chapter. In fact, if you know this, and you are done with the chapter. Okay, it's as simple as that. Straightforward. And maybe the last 4 to 5 sums I'll do will be on decision making. That's also very interesting. Okay. And that is all. If you know these 5 sets of equations, you can tackle any sum in marginal cost. And the best way to remember these equations will be with the help of the 2 income statements I gave for year 1 and year 2. So go ahead and jot down point E, the equations.
Thank you, sir.
Now, guys, remember that is those are the 2 equations for MOS, margin of safety. Okay. And with that, we complete today's session. Bye bye.
Thank you, sir.
Thank you, sir.
Thank you.